Hello all, this is your Bhavani sir. We are going to discuss day 13 Mission YODHAN, UPSC Prelims and also TSPSC Group 1 2023. Today we have given you 4 slots. One is national income accounting and also measurements of national income, money, banking. These are the 3 areas that we have given in the 3 slots, and the 4th slot is about central bank. So, we are going to discuss about first question, that is regarding GDP deflator. Usually in India we consider consumer price index and also wholesale price index, but in GDP deflator it is usually followed in western countries, considers entire goods and services produced within the country and their price rise. In India we have basket of goods which are considered to be volatile or non-volatile in nature, headline inflation or core inflation. These are basic concepts which you have listened till now. So, but GDP deflator which considers entire goods and services and their price rise, and it is also a nominal, ratio of nominal GDP given in a year, which is a ratio to the real GDP. Here you come to this conclusion, that is GDP deflator is equal nominal GDP by real GDP. What is this nominal GDP and real GDP here? The total number of goods and services produced within a year, out of this total number of produced goods and services, the rise in the prices, are given in the numerator part. Therefore, you will get entire price rise of all the goods and services, which is usually followed in the western countries, but in our country we follow only basket of goods, and also the service sector is not included in wholesale price index. With respect to consumer price index, we have services and also the goods, certain for certain basket of goods. So, this is a ratio of nominal GDP in given a year to real GDP, that is fine, and it measures average level of prices of goods services which are included in the GDP, that is not excluded. Just now I have given you this explanation, and also it eliminates the effects of price increases. Yes, definitely effects of price increases are usually effects of price increases are not being considered, because any price, any goods which are having increase, eventual increase may have spillover effect on inflationary pressure, right. But this GDP deflator may not consider the eventual spillover effect or negative externalities associated with the increase in the prices, and it does not determine the it determines the real change in the physical output. It determines the real change because this is the real GDP, which is a physical output, right, in the denominator part. In the denominator part we have given the real GDP, which is a physical output of all the goods and services visible in the economy. So, GDP deflator also call implicit price deflator. Implicit price deflator, it is not deflation. Deflation is different from deflator. This is about the question about deflation. It is asked in CAPF 2009. Therefore, we have given you these type of questions to introduce various concepts of deflation, deflator, inflation, and associated issues of WPA and consumer price index. So, let us come to the second question. The situation where the equilibrium level of real GDP falls short of GDP, potential GDP. For example, if an economy is able to produce 100 goods an economy is able to produce. Suppose if economy has not produced up to its potential, it has produced only 50, it has produced only 50 goods and services. What about it? This means the real GDP is unable to reach its potential GDP. Real GDP is unable to reach its potential GDP. That is why it is called recessionary gap. This is called recessionary gap. It is option A. In the recessionary gap, the economy is unable to reach its potential GDP. Okay, the real GDP is unable to reach its potential GDP due to its high level of unemployment, which is higher than that of natural growth of unemployment rate in the economy. This is asked in Combined Defence Service examination in 2021. Okay. I think these questions are very essential for you to do reverse engineering of all the options in 360 degrees. You have to know about demand side inflation and supply side inflation. These things are very essential. Demand side inflation, when there is huge demand in the market for certain goods and the supply is not sufficient, and there is an overnight demand for certain goods, definitely you will witness this demand side inflation. And supply side inflation means there are certain bottlenecks in the production units. Okay, there are certain bottlenecks. The bottlenecks may be associated with the mobilization of resources or manpower, technology, anything. If those bottlenecks are witnessed by the supply side, the constraints associated with supply side may create certain level of inflation in the market due to non availability of sufficient goods. This is supply side inflation, because I am telling you how to do reverse engineering. These concepts I have been explaining, you have to know, you have to learn all these concepts. These are very, very important. Next, economic growth usually coupled with CSC 2011 question, usually economic growth is coupled with the inflation, right? Why we call it is inflation? How economic growth is related to inflation? Because if there is huge economic growth, in the economy, definitely there is huge demand in the market for various goods and services. There is huge demand for goods and services. When there is demand for goods and services, consumers have more money in their hands, definitely the business will grow up. And investments will increase. Okay, the investment part and also the consumer purchasing power parity, consumers purchasing power parity. So these things will show inflationary pressure in the economy, in the market. So this is called economic growth, usually coupled with inflation. We have given high growth will lead to inflation, which is option A. Option 1 is correct, option A is correct here also, and option 2 is not at all right here. High economic growth will not lead to deflation. Next, coming to fourth question, gross GDP. What does it mean? Gross means you are considering the depreciation cost of the consumption of capital goods. Depreciation cost of the consumption of capital. Suppose if you are using a machine for last 5 years, it is depreciated and it can work for next 2 years. Okay, the 5 years of consumption of this machine is not being counted. If it is not being counted, that is called net. If it is not counted, that is called net GDP. So if you have counted this, if you have counted that depreciation cost of the capital, this is called entire GDP, that is gross GDP. But net GDP is always worth enough to calculate the original GDP of a country. So this is asked in a simple concept, asked in UPSC SCRA 2014 exam. Next, which of the following is equivalent to national income? Usually it is a product at factor cost and net product, and it is also considering national means it will consider net foreign income abroad. This is very important as essential thing you must learn. Okay, if you consider only the income that is produced within the territory of country and the residents who are residing in this country, that is called domestic production, domestic one. But here when you consider the net foreign income abroad, that means the income in the territories which are not located in your country, and also the capital income or receipts or other transferable goods, anything which are associated with other countries and foreign countries. Therefore, that is called net foreign income abroad. If it is included, that is called not only domestic but also national product at factor cost, that is at the cost associated with the land, labor, capital and entrepreneurship. And this is net one. Net means what? The depreciation cost of capital is removed or subtracted from this gross GDP. Therefore, it is called net product, net national product at factor cost. That is fifth option. Why we have given this question? It is asked in 2014 CDS. So national product at market prices. Even this market price, what does it mean? Factor cost is different from market prices. In factor cost, it will include only the cost of the factors, that is land, labor, capital. Okay, but in market prices, you will have certain costs associated with logistics, transportation, communication. All these things will be included at market price. At factor cost, it is only at manufacturing units. Factor cost is at only manufacturing units, but at market price will include the retail market system. okay, not only at the manufacturing side or production units, but also at the market areas, okay, and where it is where the good or service is being sold, the market where the goods are services are sold, that is market price. So, national product at market price are indirect, and when you subtract indirect taxes and include subsidies, this is called national product at market prices excluding indirect tax and subsidies. This is called national product at factor cost, national product at factor cost. Okay. If you include these indirect taxes, it is not called as factor cost. If it is not called a factor cost, you have to learn these basic differences. Factor cost is a cost associated with the production units at the manufacturing level. When it comes to market price, it includes lot of things, that is logistics, transportation, taxes, tolls, everything. So, and where the good at final level being sold in a particular market, that is market price. Okay. In the market price, it will also include all indirect and direct taxes and various other amenities, other things that are leading the goods to reach to the market and to the consumer's hand. Okay. This is market price. So, indirect tax and subsidies, these two will play a vital role to understand the factor cost. In the factor cost, you have to include subsidies, but you should eliminate indirect tax. At market prices, you have to include indirect taxes, but you have to eliminate subsidies. So, if you want to if you want to relate these between factor cost and market prices, whether you have to include indirect taxes or not, simple. If you exclude indirect taxes and include subsidies, this is called factor cost. This is called factor cost. If you include indirect taxes but exclude subsidies, that is called market price, national product at market price. Okay? Simple. So, the term national income represents gross national product at market prices minus depreciation and indirect taxes. Already we have discussed it. Already we have discussed in the fourth and fifth question. Right. Next, the sixth question is sign of, which is a sign of economic growth. Here, you cannot take national income at constant prices during a year as a sign of national income, because there may be an inflationary pressure which is counted in the GDP as economic growth. So, inflationary pressure may not be considered as a sign of economic growth when there is no witnessing, when you do not witness any kind of growth in the real goods and services. So, if you witness real goods and services, you can also witness the per capita substantiated and sustained growth in the per capita income of individuals. When that sustained income or growth in the per capita income of individual, it will definitely reflect in the exact economic growth of a country. This is called real sign of an economic growth of a country. And seventh question and eighth question is also a little bit similar, and we will come to eighth question directly, and later we will discuss seventh one. Here eighth question is about whether if you witness whether you have technological progress or not, the economic growth will not depend, because a country has witnessed 10 years of extraordinary technological growth in defense and space and everything, but it is suffering from lot of unemployment, poverty, and also jobless growth, or no GDP growth rate, or no real goods, no production of real goods and services, right. This and suffering from inflationary pressure. So, this kind of situation can be witnessed in any of the third world countries. They are very good in technological growth, but they are suffering from inflationary pressure and other areas, or unemployment and poverty. Therefore, it is not a sign of real income of a country or economic growth of a country, irrespective of technology. Technology may help a country to grow bigger, but it is not a mandatory thing for a country to witness economic growth. So, first statement can also be eliminated, as we have discussed in the sixth question also. It is a continuation of it simply, because these questions were asked several times in the UPSC. In 2013 also in SCRA exam, they have asked about the growth of a sector is usually impeded by inadequate growth in other sector. Yes, definitely inadequate growth in other sector will have a spillover effect, but growth of no sector is impeded by. But here technological growth will not have any kind of spillover effect on the real growth of an economy, because technology may help growth of economy, but technology may not be the criteria or the exact mandatory thing for the growth of the real economy. So, sometimes the growth indicators may be mutually independent. That is the question which is posed here in 2013. Okay, the real simply the economic growth is independent of the technological growth, but economic growth is not independent of the capital formation, because if there is no capital formation, there is no economic growth. You cannot witness a substantiated increase or sustained increase in the per capita income or entire real GDP of a country. So, capital formation is essential aspect to witness this kind of real growth in the economy, real growth in the economy. Next, with respect to population, no, population explosion will not help growth in the economy. So, this a third option is also wrong, only second option is the right one. So, C is the right answer. And when it comes to seventh question, disposable income of a country equals to, disposable income is what the country which is which has witnessed the real income in the hands of the public, okay, in the hands of the public, simple. So, the transferred payments payable to the government and the transfer payments payable from the side of the government to the public. If you consider these two elements, you will infer the disposable income of the out of the total national income of a country. If total national income excludes this payable, the current transfers payable to the government, excludes current transfers payable to the government, that means an individual or household paying to the government in the form of direct or indirect taxes. Okay? If you exclude these things and include certain things that are schemes and policies and various benefits and beneficiaries associated with the government things, that is subsidies, those subsidies are receivable to the households. So, if households receive these subsidies, which are included as part of their original income only here in the national income, if you include these subsidies are receivables or transfers receivable to the households and transfer payable to the government from the households. If you exclude these things, if you exclude this, if you exclude this, if you include this, if you include this, therefore, you will get national income with disposable income of of a country. Okay, disposable income of a country, this is called, simple. Next, 10th question. Let us come to 10th one. Consider the following statement with regard to Monetary Policy Committee. Monetary Policy Committee. Here, Finance Minister of India is not the ex officio chairman of Monetary Policy Committee. RBI Governor is the ex officio chairman of Monetary Policy Committee. It is required to meet at least 4 times in a year. Therefore, this is also wrong statement. Say first statement is wrong and second statement is also wrong here. First statement and second statement both are wrong. And each member of Monetary Policy Committee has one vote. If there is any equality of vote, any event occurs that equality of votes, then the RBI Governor, who is ex officio chairman of this Monetary Policy Committee, can cast his vote. Simply if you observe third statement and the first statement, if Finance Minister is ex officio chairman, just if you consider Finance Chief Minister is ex officio chairman, how can RBI Governor can have this ex officio vote? Therefore, RBI Governor definitely should be the chairman, or Finance Minister should be having the casting vote, mutually introductory, mutually contradictory, right, the first and third statement. If you consider Finance Minister in the first option, definitely you have to consider him in the third option. If you do not consider Finance Minister in the first option, you have to consider RBI Governor, who is having casting vote in the third option. Therefore, you have to eliminate first option and choose third option mandatorily. Okay? And this is a basic understanding how to deal with the question pattern. So, second statement is wrong, first statement is wrong, third statement is right. The Monetary Policy Committee determines the policy of repo rate required to achieve the inflationary targets. Yes, Monetary Policy Committee has targets of 4% of inflation plus or minus 2, plus or minus 2. So, this is usually target of the Monetary Policy Committee, it will deal with it, right. The Monetary Policy Committee question was asked in the UPSC in 2017. It is called reverse engineering process. Each of the MCQs should be read in 360 degrees. We have given you the members of the Monetary Policy Committee. We have ex officio chairman, that is RBI Governor, and 2 other members, Deputy Governor, and also one nominated by the Governor Board of Directors in the RBI itself. So, 3 members from the RBI, 3 professionals are the experts who are expertised in the field of economics, 2 professionals, 2 eminent persons, and applied economic research, one eminent person from applied economic research. So, one eminent person from Applied Economic Council of Applied Economic Research, and 2 eminent persons, professors from this area, and 3 persons from the RBI. So, the committee consists of 6 members, one is ex officio member, one ex officio chairman, he is termed to be governor of the RBI. So, monetary policy committee consists of 6 members totally, simple. Next thing, 11th question, which statement given below with respect to standing deposit facility? The standing deposit facility actually replaced the fixed reverse repo rate as the floor of the loan and liquidity adjustment facility corridor. What is meant by liquidity adjustment facility? As you have known that repo rate and reverse repo rate, right? Repo rate and reverse repo rate, these things you have known, repo rate, reverse repo rate already. When it comes to monetary policy, whether there is high liquidity in the market, whether there is high money is in the hands of the public or not, the simple question is whether huge money is in the hands of the public or less money is in the hands of the public, simple in the layman terms. If there is huge money in the hands of the public, there is huge inflationary pressure, therefore, some money should be sucked by the RBI. Okay. If there is less money in the market, the money should be pumped into the market, simple. So, this is a liquidity adjustment facility in which banking system and also RBI participants are stakeholders in which. Okay. What is this liquidity adjustment facility? In a overnight, when there is huge money in the market, some money should be taken by the RBI from these banks. This is called liquidity adjustment facility. Otherwise, some money may be observed or released to the banks if there is less money in the market. Okay. If there is any kind of mismatch in the day's end, at the end of the day, if there is any mismatch at the end of the day in the balance sheet of the banks, if there is huge money available in the banks, therefore, uncollateral deposits should be made to the RBI from these commercial banks. This uncollateral deposit which is made to the RBI from the banks on overnight basis to adjust the liquidity in their banks, this is called standing deposit facility. Standing deposit facility. What is standing deposit facility? Uncollateral deposits which are taken by the RBI from all commercial banks on an overnight basis. This is to adjust the liquidity in the market, those participants who are participating in this liquidity adjustment market, right, that is repo rate and reverse repo rate area, market area. So, this is all about money market simply. So, this is therefore, the first question uncollateral, this is the second question, both the statements are right. This is, and 25 basis points means what? Out of 100%, it will have only 25%, means it has 0.25 of percent of less than that of policy repo rate. So, out of 0.25% of less interest being done, being prepared or being paid compared to policy repo rate under this second option. Okay. This is also true with respect to standing deposit facility. Next thing, 12th question, the percentage by which the money the borrower pays back exceeds the money that was borrowed is called nominal interest rate. If a person is actually is 100% loan taken by a person is 100%, simple. Let us consider this is 100 rupees, but the person is charged 5% interest rate, 5% interest rate. If this person after 1 year pays 105, the X person who is a borrower pays 105 rupees, to the Y, the person Y. This is called nominal interest rate, that is the 5 rupees is the amount, the 5% is the nominal interest rate for 1 year. If the inflation rate, because the next question is about that one only, that is why I am explaining, please focus on it, If inflation is also 5%, what will be the situation? If inflation is also 5%, the person Y is the lender here, this lender will not witness any kind of real interest rate, because here person Y has purchased 100 goods at 100 rupees initially. okay, 100 rupees in the previous year. Suppose if hypothetically person Y has purchased 100 goods at 100 rupees in previous year, the same person Y has purchased same 100 goods at the rate of 105 rupees, same 100 goods at the rate of 105 rupees. What is the actual output that person Y got here? Same goods, because the goods, the price of the goods is increased in the next year. So, the person Y has not witnessed any kind of potential growth in his income status. Therefore, person phi has lent some amount to X. X has given extra 5% as nominal interest rate in the next year, but the real interest rate is 0. Real interest rate is 0 because of the inflation. If you do not consider inflation, if you consider only the interest rate that is paid to the lender, if you do not consider any inflationary pressure, that is called nominal interest rate. If you consider the inflationary pressure, that is called real interest rate. I have explained the upcoming question also here when it comes to nominal interest rate. Okay, upcoming question also I have explained. I will teach when it comes there. I will explain again once again. I will just reiterate. Choose the most appropriate option among the given below. Here the most appropriate one is why only income is considered to be a current transfer which is being influenced. Suppose if current transfer is what? Suppose I have done 100 rupees of Google Pay to you, 100 rupees of Google Pay to you. Okay. Will it change anything to my entire wealth? No, because this is a liquidity. Means it can be changed or converted into money at any time. It can be paid to anybody. It is not a fixed asset, and it will not yield any returns also. It will not yield any extra result. It is not an investment. It will only affect my income status. Because if I get extra 100 rupees from you, I will enhance my income status only, but it will not show any substantial increase in the status of my wealth, because it is not used for capital purpose and it is not yielding any single rupee. So, therefore, a current transfer influences only economy, it is not influencing the wealth. Okay, it is not influencing the wealth. So, the other three options are very simple. It is influencing only wealth is wrong, and it is influencing both income and wealth is wrong, and it is influencing neither income and wealth is also wrong. Next, which of the following are examples of near money? Near money is simply a money which can be converted, the asset which can be converted into money as early as possible. Suppose if you have 10 years of fixed amount in the bank, you cannot convert it into money as early as possible. But if you have treasury bill of 90 days, you can convert that into money as early as possible. Okay, the asset that you have built and can be converted, the asset which you have built that can be converted into money as early as possible. That can be converted into money as early as possible. That is called near money. That is called near money. So, this is bill of exchange, bonds, certificates and short term bonds, it seems. Okay, treasury bills, debentures. These are short term liquidity funds which can be converted into money, but they are considered to be assets only, but short term and having more liquidity in nature. Consider the following statement with regard to statutory liquidity ratio. To measure what do you measure? Commercial banks can usually bank, no, can cash, no, they can, commercial banks, to measure statutory liquidity ratio, commercial banks can use cash or any kind or security, it seems. Okay, or any particular security which is given to the banks, commercial banks, by the RBI on behalf of the government. Okay. Statutory liquidity ratio restricts the bank's leverage in pumping more money into the economy. Yes, definitely. Statutory liquidity ratio means what? The security in the, the securities of government on behalf of the government also, RBI which has given to the commercial banks. the commercial banks have to hold this security and they have to pay the money to the RBI. So, commercial banks may not be having more money in their banks and deposits, therefore, they cannot lend more money to the market. When they cannot lend more money to the market and they are putting lot of money in the form of securities and in the form of securities which are put in the hands of the RBI, this is very difficult to pump more money in the market. So, it will squeeze the money in the market when you have more SLRs in the hands of the RBI which are purchased by the banks, commercial banks. So, this is also very important. Next thing, consider the following statement, that is Indian currency notes, coins are actually as per 2011 Coinage Act, it was amended from time to time. The government of India vests the power of minting the coins. Therefore, the first statement is wrong here. Interbank deposits are not included in the total money supply of the economy. This is very important concept again. It is very interesting concept. Though RBI has the right to print the Indian currency, the Coinage Act is providing the sovereign body, that is the country, responsible, the government of India has the right to mint the coins. That is fine, first statement. But what about the second statement? Second statement is not giving a definition of not giving interbank deposits are part of this total money supply of the country. Why? Because see, net demand deposits include only net demand. Usually deposits means net deposits made by common public in the banks. Net deposits made by common public in the banks. This is, and also interbank deposits. Suppose Union Bank deposited some amount in Canara Bank. Just consider Union Bank. This is also net demand deposit. Fine. Net demand deposit in the form of layman deposit or common public deposits in the banks, and also interbank deposits. These are two types of demand deposits which are part of net demand deposits. But when it comes to money supply in the entire economy, when it comes to supply of money, it will not consider interbank deposits. It will only consider the deposits made by the public in the banks. Simple. Okay. I am Bhavani Shankar. I am actually putting some amount in my bank to withdraw whenever I want to. This is called a net demand deposit, because it is not a fixed amount. It is not fixed for 10 years or 5 years. I have deposited some amount, that amount can be withdrawn any time. This is net demand deposit. But this is only considered as part of money supply in the economy. The money supply in the economy will not consider deposits made by one bank in the other banks. Simple. That okay. But net demand deposit considers money deposited by the public and also money deposited by one bank in other banks. Simple. So, this is simple. What is meant by money supply means what? You have known the money supply, the currency in the hands of the public, currency which is put in the form of demand deposits in the banks, and also the deposits which are fixed, M1, M2, M3. M3 means term deposits. Okay, term deposits. Here 2002 UPSC CS, term deposits, that may be 3 years or 5 years or 10 years of term deposits. Okay. So, not only current demand deposits, but also the fixed demand deposits, fixed term deposits. Okay. Time limit, they have certain time limit. So, this is called broad money, that is why M3 is considered as broad money. So, within the same year in the CSC 2002 they have given the same question, but orientation is little different. In combined defence service exam and CSC in the same year they have asked regarding this money. Okay. Next, functions of money. Among the following functions of money, acts as a, what is that function of money? It is an intermediate exchange process. This is a very layman understanding, easy to put right answer, easy to get right answer. Acts as a store of value. Yes, definitely when money is in the hands, it will enhance the value, definitely. Next, used for regulating consumption. Money will not regulate the consumption actually. Money can act as a store of value for individuals, and it can be it can also act as convenient unit of account. Okay, it is a medium of exchange. These are simple applied economics. Okay, it is easy to apply these basic concepts. Next, GDP accounting of a country. GDP accounting of a country. what are the things included in the GDP and what are not included. Here the ownership status of goods and services play important role while accounting for GDP. No, ownership status, irrespective of ownership status, it only includes the goods and services produced within the territory in a specified period, simple, or in 1 year, irrespective of ownership status, whose ownership it may be, but the number of goods produced or not, this is the only criteria that GDP calculates or counts. Next, an oil company oil company spills oil in the ocean, causing lot of environmental damage. These negative externalities are not included in the GDP. This is one of the drawbacks that we witness in the counting of GDP process, right. GDP accounts for opportunity cost, yes, definitely, because okay, sorry, one thing is very important. GDP, when it comes to here, the question is about incorrect one. Question is about incorrect. When it comes to incorrect one, you have to bite once. Therefore, you will remember for next 2 minutes. So, it is very essential for you to remember this incorrect one. Okay, because the first statement will not consider, and this is incorrect one. You have to choose, because the question is about incorrect. And GDP will not account this negative externalities, these negative externalities. You have to, actually it is a correct statement, but you should never consider this, you should never consider second statement. You have to consider the third statement, because this is wrong statement. GDP accounts for the opportunity cost. Why? What is mean by opportunity? Not account, it does not account opportunity cost. Why? Here I want to choose MPC, I cannot choose BPC. Okay? If I want to become engineer, I cannot become a doctor while choosing my options in my intermediate exam. So, this is very simple. While opting one opportunity, you may lose other one. GDP will not calculate this one, it will not consider this opportunity cost, but here this is incorrect statement. GDP accounts for opportunity cost is absolutely wrong statement. So, 1 and 3 are incorrect, you have to choose 1 and 3 only, because the question is about incorrect. Second statement is correct, you have eliminated that one. Next, with reference to value added method for national income accounting, consider the following statement. This value added and this GDP at factor cost and at basic prices, you have to remember two things. What is mean by this GVA basic price? In the GVA basic price, it will include factor cost and also production taxes, and it will exclude production subsidies. It will exclude production subsidies at the level of production units, at the level of production. What is mean by gross value added at basic prices? At basic prices, it will include the costs associated with land, labor, capital, that are factors of production. Okay, simple, it will include, and at the same time it will also include the taxes in it, because if you do not include taxes, how will you have a basic price for that basic retail price for that good? Because the production cost is also given, the production cost is also calculated already, and the tax associated with this production cost should be included to get a final cost of that product. Okay, final cost of that, this is called a basic price, but you have to exclude subsidies here, because the subsidies are part of you, that have benefited you. Okay, that are part of your production benefit. Okay, to make your production less cost, at less cost. So, you are already benefited, that benefiting part should be eliminated here. In a layman terms, I am talking about these economics. Okay, and when it comes to this market price, you have to include these basic prices, which is calculated at factor cost only, which is calculated at factor cost, and taxes included at factor cost only. Taxes included. When it comes to market price, you have to include at market level of taxes, at market level of subsidies. You have to exclude market subsidies and you have to include this market level of taxes here. So, do not get confused at both the stages it has given production actually, do not get worried, because when it reaches to the market, it will have lot of commutation, transportation, logistics, communication cost. Okay, and also certain taxes associated with it, the tolls and indirect and direct taxes, everything. So, at this stage you have to include, that is GVA, gross value added, GDP at MP, you should include summation of gross value added at basic prices, summation of gross value added. What is gross value added? At micro level, one unit may have produced these goods at this cost. This is a factor cost price, and it has paid certain amount as tax. It has paid certain amount as tax. So, you have included if I included the tax paid by one entity to the government at certain place of certain entity, only one entity. When you have given the summation of all the entities, factor cost, and also the direct or indirect taxes which are paid by them to the government, and if you exclude the subsidies, definitely you will get the GDP at market price, GDP at market price, simply summation of gross value added at basic prices, and which includes the taxes and excludes the subsidies, is called as GDP at market price, GDP at market price. Simply this is a simplistic understanding of GVA of and GDP, GVA at basic prices and GDP at market price. Next, consider the following statements with regard to RBI as banker to the government. RBI as banker to the government is very simple. See, as a banker, RBI, what are the functions that RBI has to do? RBI has to do the function. First one, RBI regard to conduct of government's banking transaction under section 20 of RBI Act, it is obliged to undertake the receipts and payments of the central government and carry out this exchange market. Okay, it will deal with the exchanges, receipts and payments made by the central banks and also made to the central bank. Central bank, not only the central government. So, it will deal with all remittances and banking operations of the government. This is the banker of the government, simple. And second thing, next fourth statement, when it comes to fourth statement, RBI discharges its statutory obligation of being a banker to government. Not only it will deal with the transactions, that is receipts and payments made by the government and to the government, and it will not only account those details, it will also deal with the and it will also acting as a banker to the government. What is mean by it? RBI lends some amount to the government, RBI restricts amount to the government, RBI will take some amount as loan from the government in the form of securities from the government. RBI holds certain securities from the government and gives some amount to the government. So, either lending or RBI actually gives certain securities to the government and take money from the government. This is called banker to the government, right. So, RBI's role in goods and service tax regime, what does it mean? It is an aggregator of accounting all GST collections. Aggregator of accounting all GST collections means what? Simply RBI, it is acting as a facilitator of payment of GSTs. Acting as a facilitator, suppose RTGS, NEFT modes, and also facilitator of payments made to the government, GST payments made to the government directly into the accounts of the government by the taxpayers. This is called, this is RBI acts as aggregator for accounting of all GST accounts. RBI acts as aggregator for accounting of all GST accounts. All GST accounts which are paid directly to the banks of the to the accounts of the government from the public. This is called, this is a first statement given here. RBI of India is the aggregator for accounting of all the GST collections. All the GST collections are aggregated, and it is acting, RBI is acting as facilitator which is to be paid to the government from the taxpayers. So, it is an aggregator for accounting of all GST collections. The respective. Next, according to RBI Act 1934, RBI has the obligation to undertake the receipts and payments of the central banks. Just now we have read it. Next, all states in India entered into an agreement. No, all states have not entered into an agreement with the RBI for conduct of their government transactions. Sikkim has not entered till now, except Sikkim. Other states have entered into an agreement to deal with the transactions of their respective states. Okay. RBI has entered into an agreement with all the states except Sikkim to deal with the transactions of those states. What are the transactions of the states account? Means the receipts and payables by the government and to the government, to and from. Okay. Simple. Next, RBI carries out the general banking business of the government through its own offices and commercial banks. Yes, definitely, and both public and private and appointed as its agents. That is true, and this is definitely we have read just now in the fourth statement, right, when it is acting as a banker to the government. This is about our test explanation. I think this explanation would have helped you. All are based on our previous year questions only. The themes are based on previous year questions. So, this is a live session. You can ask any kind of doubt in our live chat. I will give you the reply in the form of voice or in a text message within the comment section. Okay. All the best and thank you.